if you're not a professional investor, you tend to be if you're not a professional investor, you tend to be more focused on the name,
Right.
you know,
the thesis, the little story behind it. And
right. As professional investors, I don't need to hear you. That tells me everything.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
Another edition of the Daily Dots, and I am joined as always by the brain trust himself, Mr. Chase Taylor. I don't really have any superlatives or any clever catchphrases for the action today. The one thing I did want to get into, though, generally speaking, is that jobs revision number. Right?
Yeah.
When did that came out this morning? Right?
Yeah, this morning. Yep, 10 Eastern.
Okay, and so walk us through that and let us know. Yeah.
Yep. So we get these, I think, twice a year. You get a preliminary, and then you get basically a relook that's even better on basically like a whole chunk of jobs data. They look at like essentially a whole year's worth. And this revision typically, it goes from sort of soft data to hard data, right? Where you take just counting some survey stuff, and then you look at harder data to like solidify it. So that's what they did. This one was the biggest negative in history. It was over 900,000 jobs were revised out. We knew going in it was going to be really big. So the estimates were essentially from like 700,000 to 1 million. So it definitely came in on that higher end. The market didn't really respond to it at all. So clearly the market had already priced in like, yeah, this is gonna be bad. Like everyone's been talking about it already. And last year we had a really big one that was like, I don't know, 8 something. And then it got revised back to 6. So it was like, wasn't as bad as we thought originally. But that's 2 years in a row. You've had a lot of jobs get revised away. A lot of it's that birth death model. And that sounds like it's about people. It's about businesses. They've been overestimating how many new businesses are formed. We had an explosion of that stuff thanks to, people opening LLCs for Uber and crap like that. It makes it look like, like this huge boom in new businesses. So they sort of like extrapolated that number, and then that all washed away. So then every time they get the hard data versus the assumptions they make on that, it's like, oh man, we were way off. What's getting a little underreported is they've already cleaned that stuff up. Like they maybe have farther to go, sure, but like they have tweaked that stuff to make it make more sense. So you're seeing less of that. So like the next one we get next year will probably be it'll be tighter. So not nothing to lose that many jobs that we air quotes thought we had. And I think most people following it closely knew we were overstating those things in 2024. But.
Yeah. I mean, I'll be honest with you. I saw that jobs revision and my first thought was that makes sense.
Yeah.
Like I was like, okay, I feel because there were so many parts of the economy where you're like, look, if the growth is what you're saying it is, this shouldn't be happening or that should be happening. You know what I'm saying? And it's not like things look horrible, but there's a difference between, hanging out slightly above stall speed and rocking and rolling. I think it's a big stretch to say that this economy has been rocking and rolling over the course of this year.
And we saw we had this weird stretch of people may remember like where every month you beat expectations by a lot. So like economists would, work really hard to come up with a number and it would be like, double that. And this happened month after month after month, and people that were bears on the economy were getting made fun of for like constantly getting it wrong because the jobs were way better than expected. But if you go back and look at it, it's like, well, actually all those economists' guesses originally were probably pretty good. We're just over reporting jobs for 2 years,
Yeah. And you've always had these issues with data, but my feeling right now is, and it's one of the weird feelings or one of the weird aspects, at least as it relates to me for this market and economy right now, which is because there have been so many extraordinary inputs there are so many data points that seem to be conflicting. And then you look at it and you remember, you're like, people need to understand that so many of these data points are built on historical norms, right? What we typically see, right? Well, when you're in an environment that is so atypical, it's not right. You can't just sit there. Oh, they're cooking the book. Like
they're forced to make assumptions.
Yeah. What model are you supposed to use to, you know what I mean? There is no outline. There is no framework what other times can you go back and, I'll use one small example here, but what other time can you go back in US history and compare a time where we're running 7% deficits with 130% debt to GDP? There aren't any, right? So, is that going to impact Of course it is, right? How are we going to see? There's so much of that. Then you inject something like AI in, right? And all the different power use, like you look at how many curveballs that throws into the economy. Then you look at what AI itself will do. I think that this kind of gap in data and quality of data and being able to really trust the data we're seeing, I think that is getting less so because there's so many extraordinary inputs. And I think that's something that investors are really going to have to keep in the front of their minds for quite some time, just because the environment is so atypical. And we in investing always use historical, references, right? We just have to be exceedingly, and you and I talk about it internally all the time where we're like, well, if this was normal, this problem is it's not normal.
Yeah. When it comes to jobs data, like at the end of the day, you just have to triangulate between multiple sources and recognize even then, like it isn't perfect. But like if you look at ADP lately, like you've been revising non-farm payrolls back pretty close to where ADP was to begin with. And everyone, like it went from the whipping boy to like the standard all of a sudden, where, you'll have a big delta between those two. And then a month or two or three later, next thing you know, the revision is like, oh, well, ADP was more right. And then if you look at ADP's revision itself, like their last one was a 2000 revision, 2000 job revision. So like, wow. So they're saying like, oh, well, we could do it without these giant revisions.
It's always made fun. That actually makes a lot more sense to me. I was really surprised. And it was the way that everybody in the market looked at it. So you had to treat it that way. But I was just always surprised that ADP wasn't looked at and valued more, just because it's more direct data.
Right. It's payroll data.
Right.
Not a survey.
Right.
I mean, yeah.
It doesn't surprise me that they've gotten it to the point where it's way more accurate now, just because if you wanted to see that, I mean, looking at LLC filings, I mean,
it's hard data and the sample size is decent. Like and then now there's a company called Paychex, again, payroll. You have Homebase, like, and all these people are publishing, and I'm missing a few, publishing high frequency jobs data, jobs openings data, all this stuff. So if you splice all that out, smash it together to make your own little index or whatever, like you just get a way better feel for, like, I don't know, what does the non-farm payrolls number say? Never mind the fact that, these companies have 3 months to respond to that survey. That's why you get those revisions. It's not because they're like, oh, we were wrong. It's just, maybe 30% of the 40% of the 50% of the companies didn't even respond the first month.
Mm-hmm.
So they come back the second or third month. They're like, oh yeah, here goes 2 months ago's data. And they're like, oh, okay, well, we got to go revise that. And lately it's been in the other direction.
Yeah.
But that's just slow survey response leads to revisions,
Right. Yep. What else? What other news do we have out today? The other thing too, the indexes, not a lot going on there, but let's get a little rundown there.
Yep. We closed up 0.27 on S&P, 0.28 on NASDAQ 100. But on the flip side, small caps down 0.6 and down more after hours. Equal weight down 0.3. And equal weight, that, I don't know, man, that chart just looks really tired. So we gotten back to like cap weight kind of doing all the work lately. And Mag 7 doing the work. So Mag 7 was up 0.7. All world XUS was basically flat, up a little after hours. And that the crazy thing to me here is you have all world XUS, if you factor in after hours, up today, and that's with the dollar up 0.37. So very solid performance given the dollar move higher. Bitcoin is at a 111. Basically, we just hover around 110 every day. Oil's under 63, barely moved. Gold down a tiny bit, about 36.70. Silver down a little over 1%. Platinum, palladium, both within like 1% flat. The 2-year was up 6 basis points despite that jobs revision, which is kind of interesting. And we didn't really get that much other data. Weird. Maybe it just got a little overcooked on this past Friday and stuff. But 10-year was up 4 basis points. That stuff had gone straight down since the jobs report. So it just could just be, bouncing here. One notable thing was Apple. They had the release of the new iPhone 17, and they ended up down about 1.5% on the day. And Google was actually a good bit of max having the day up about 2.4. And one other notable to me, as usual, FXI, China's large caps were up 1.3, and Alibaba was up over 3 at last check. Ended up over 4. So decent performance there.
Yeah, man, it makes me feel a lot less crazy seeing the run in Google. We're just like, and it certainly wasn't as cheap as it was a little bit ago, but still you sit there and look at that company at 25 times earnings with everything considered. I mean, people will think I'm crazy for saying this, but if you like straight up, and I think Amazon's an incredible company. I am shocked that people would pay double the valuation for Amazon they would for Google. Yeah,
it makes no sense. Full stop.
I just don't get it. Yeah. And I could absolutely end up being wrong. I'm just saying, I just don't get it. And I love this. As always, none of this is investment recommendation. We have not acted on this at all. Gold gives me it's giving me the willies. And not long-term at all. My long-term outlook has not changed at all. It just feels too far too fast right now. I just feel like you got a correction coming.
Yeah, the policy mix is basically just pure adrenaline for gold. I mean, you couldn't make a better policy mix, not just nationally but globally. Very much nationally, but also globally. But and we talked about this in our investment meeting today. Like you're about 50% above the 200-week moving average. This was an interesting stat, which is one thing that which is more than we got in that run up post GFC. A good bit more, which on its own doesn't have to mean a whole lot. But for me personally, like I just have my own little radar for people getting too excited about something I like. Like I've mentioned, like the Chamath getting bullish China, it bothers me on China, right? Mm-hmm. Like, and when it comes to gold, like I've seen a lot in the last week or two of people getting interested. We talked about this, like Tether's talking about buying gold miners. And it's like, okay, maybe last year, man, but like, and they're supposed to be backing a stable coin with pretty hard assets, like T-bills usually and stuff. So to go like throwing money at equity, not just equity, but volatile equity, it's like, oh man, what are we doing? Like it's just stuff like that. I've seen CNBC talking about it, and they usually don't. They've been talking about it a lot lately. I mean, I'm getting research from Goldman and JP Morgan and stuff all about how great gold and gold miners are. And it's like,
I don't know. The only
where were you guys a year ago?
The only counter to that is I still have yet to see The Economist post anything regarding gold.
Yeah,
regarding gold isn't negative.
If they do, forget about it.
Yeah, I mean, just they like no matter what, they are always going to tell you the reasons why gold's about to plummet. Like it's just they are.
If they have a got gold, that's something, man.
That's the top.
Yeah.
If The Economist flips, right? That's like the death of equities.
I'll buy canned food.
Yeah, that's like the death of equities in 81, right?
Yeah.
The ultimate buy.
Remember the death of coal one that marked the bottom in coal? That was a beautiful one.
Yep. Now, the one thing I will say, and I thought that stat was really interesting, that you're currently 550% above the 200-day at the very very peak 200 week. Yeah. And at the very peak in 11, you only got to like 20%, right? Was that the number?
30, I think it was, maybe 30? 20, 28, something like that.
So you're almost double as extended there. Here's a difference from somebody that lived through that. And the reason why the counterbalance that argument is underneath the surface at the time. What was going on in 11 was the extrapolation, right, out into the future of earnings and things like this. What you see happening, especially with the miners right now, is just the price finally responding to the unbelievable earnings boom, right, 100%. That is happening. Now, so if people think that this is like a mania top for gold miners, I do not think so
No.
at all. But you have to look at the historical record of sectors like this. Getting 30 to 40% pullbacks in miners in a gold market, a gold bull market, is the norm. It's not the exception, right? And, you know, we talked about it. Like, when I look at the gold miners right now, they're really the kind of stocks that I want to own. And the only activity I want to take is to buy more when they go down. But when I manage other people's money and I manage risk, I can't do that, right? Now there's a certain amount of them that you keep no matter what. That we're gonna, you know, that are what I call, you know, nightstand type holdings.
Eating some vol and some drawdown is just the cost of doing business.
Yeah, but but the flip side is when you've, you know, that sector's up 100%, and it's been our most overweight sector this year.
Yeah,
when you make that much in a sector over such a short period of time, you hate doing it, especially when the financials are what they are. But you just can't let anything get too large. You know, it just. Sizing is really important.
Yeah.
And the funny thing is too, I always laugh because, and it's not, I don't want to be condescending when I say this at all, but like, it's funny when you get around other professional investors, I feel like the conversation that always attracts the most of us and the most back and forth, and it's always the most stimulating, is usually the sizing discussions. You know, everybody kind of, you know, if you're not a professional investor, you tend to be more focused on the name,
right?
You know,
the thesis, the story behind it, and
right. As professional investors, I don't need to hear your story. Just show me your sizing. That tells me everything.
Yeah,
you know,
it's funny. I did one of the solo shows last week. I just talked a bunch about trade location and why that's so important to me. And it's like, this is the thing that, you know, the average investor is not gonna even know about, think about. Like, it just, because you want it. It's how cool is this stock and why is it going to go to the moon?
Right.
You know, but like there's these little nuances that, you know, if you're in the trenches every day with a portfolio, like, are super important. And that's another just really good example of that position size, what it means on the way up, what it means on the way down, like how you manage risk in something you hate, something you love, something that you're not sure about. Like, it's also different.
There was another valuable story too that I wanted to highlight that you brought up the other week, and it's not to dunk on anybody. To do this job, everybody has good calls, everybody has bad calls. But to show, if somebody ever hears me say, I don't watch CNBC, and I don't, I used to have it on in my office. I will tell you full stop that I am a better investor when I do not have it on.
I believe that.
Yeah. It's vapid.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
But it's also why you can't listen to people and solely, especially when you're not doing your own fundamental homework. And it continues to be anathema to me. I will never understand it, but how professional investors can be so influenced by price movements. Meaning, you were talking, there was a segment on CNBC at some point in the last few months or whatever, where they're basically sitting around docking on Google, bragging about the fact they made a quick scalping trade and collected like a few percent because it's a dog and you don't want to touch it long term and all that kind of. And you listen to it, and all of their arguments made sense if you looked at the chart of the stock in relationship to the NASDAQ and the MEG 7.
And did not research into the stuff they said, because most of it was not true. But yeah.
Then you listen to their reasoning and you went, that's just not true. I don't disagree with you. That's just not true.
30 seconds later in perplexity, like, nope.
Yeah. Well, then, a lot of people saying, look, you got to just Google, Chrome's a 0. You just got to throw it out. And you're sitting there going, at no point in this whole thing was Chrome ever going to be a 0. It just wasn't. If they had to divest themselves of it, they'd have sold it. They'd have spun it off. And it was so stupid. And yet, if you listen to them, you missed out on what was an extraordinarily low risk, high chance of success opportunity at a very cheap price in a market that doesn't offer them. And it's why that was just another classic reminder of, because it shocks me all the time too, right? Even though I'm in the industry and I've been in it for almost 20 years. And at this point, I've pretty much seen it all. I'm not an old beard, but I'm gray, right? I've been in the driver's seat for a while now, and you just cannot fall into that trap thinking that people are speaking about something that they've actually done the work on, because
100%.
because most of the time it's not the case.
And it was a podcast with a CNBC star, but not on CNBC. And it's like, they're filling like an hour a day basically.
Yeah.
And they were just ripping through different names. Like, so it makes sense that they wouldn't know all the stuff, right? But that's where, like, if you listen to it and you're like, oh yeah, Google's a dog, I guess, because this smart guy said that. Like, do a little work, right? If you threw a bunch of names at me all day, every day, like, I would say some really dumb stuff about a lot of names because I don't know, right?
Yeah, I know, but Google's a surprising one. Like,
totally fair. It's
like,
Max.
like if we're talking about like Archer Daniels Midland and you're not up to date on it, understandable. But Google,
last check, very bad.
yeah. I mean, that's certainly not a reco. No, but you know what I mean? Like, your Google, and then like I said, to like the facts were so easy to find. And it's, again, just be careful. And I cannot tell you, the other thing I will say is this: one of the reasons why you want to do that is not to avoid potential losses. See, I have discovered some of my best wins that way, where you sit there and all of a sudden you realize, because you've done your own work, you realize that the commonly accepted narrative is just completely wrong. And you're like, look, I know I'm going to have to sit here. You and I said that about Google nonstop. I'm going to sit here and it's not going to be fun until all of a sudden this thing's going to get re-rated in a very short period of time because the narrative is incorrect, right? So again, all these things point down to doing your own homework. And it's to the point where just how much we really believe that. And I know you're the same way because we've talked about it. When we hear everybody universally panning on a stock, we almost always take a look for that reason.
Right.
If
something's loved or hated, it's fun to look under the hood to see if there's any there. And that's how you find a lot of stuff. The funny thing to me is, me, I'm a big chart guy. Technical analysis is a huge part of my process, right? But then I find myself like, it's just so obvious so often that these things that get a big narrative behind them, whether good or bad, is just because someone pulled up the relative performance or the chart of the last 2 years and then they just made an opinion. Yeah. Like, you're talking about, like, do your own homework. And we're not talking, it doesn't have to be some, like, you wouldn't have to make a 40-page thing or a model and Excel or like, it's just, what's the valuation? Like, what are the basics of the business? How is it roughly trending?
What are their margins? Right. What is their competition? How does their competition compare? Yeah.
Like, pretty basic stuff. You could do, no kidding, 2 hours of work that includes some 5th grade math, and you could literally get an edge doing that. Now, 25 years ago, everyone was doing that. Maybe you have to go a little farther back, but like now, like almost nobody's doing that. Everyone's just looking at the chart and seeing what people are tweeting about it. And is it going up a bunch or going down a bunch? And like, oh yeah, this is great. This thing's awesome. You need it. Or like Duolingo was at like 30, 40 times sales. And it's software to teach you how to learn a language. Like, and it's gotten killed since. Like, sorry, that never made sense. Like, no. Like there's some things that are just dumb. Yeah. And vice versa. Like, there's things I talked about it last week, like offshore. Every time I dig deeper into some of the numbers and just infer what is likely to happen in the next 5-10 years, it's just like, this is crazy.
Well, yeah, it is crazy. And I'll just say it, like, if you're going for maximum returns over a piece of period of time, I don't think that there's any way that you can generate. And I think of like a guy like Cuppy when I think about this. I don't think that there's any way in this market to generate extraordinarily outsized returns unless you take that approach. But the cost of that approach is 40 to 60% drawdowns. Like,
which offshore is in, despite the fact that as long as you can zoom out, everything's awesome. And it's clearly going to get better. Now, if you look at the last year's earnings revisions, they went down. And so the stocks are like, cool, let's just get cut in half on that. Yeah. Never mind the true basics of the industry being amazing. Yeah. And like, you look ahead 3 years and you're like, wow, and everyone can do that. We all have eyes. Like, we can all infer basics of the economics of an industry. Like, literally anybody can do that, but no one did.
No. Right? And you and I, like, again, I don't think it's the only way. And I don't even think it's an appropriate way to invest, especially retirement money, because that level of volatility can be horrifically destructive to somebody's retirement plan. And people are like, well, if it succeeds in the long run, well, when you're taking income out of a retirement portfolio 40 and 50% drawdowns are a problem.
Huge problem. Yeah.
Huge problem.
You really messed with the math.
Yes. I mean, it kills you because it's forcing you to do the exact opposite of what you should be doing. You're forced to sell bottoms. Right. And it kills you. I mean, the math is compelling. If people didn't realize that, you're like, why do raging bull market, risk management, and you're like, yeah, it's like laughing at people to buy a rain jacket. You're like, hey, wait for the storm, man. You'll get it.
Yeah. The best definition of risk is the thing you haven't thought of and you haven't prepared for, no matter what.
No matter what. Right. That is by definition of what it is. Right. And it only is a problem when you don't expect it. I mean, So that's just the issue.
So when everything is going well, it's probably when you should think about it the hardest.
Yes. Now, what I will say, though, is that I still believe, and I've got a bunch of different ways of proving that, is that if your game is all about maximized returns, regardless of volatility over any period of time, an extended period of time, first of all, you naturally have to have a longer time horizon when you're doing that. Because if you're correct and something is that undervalued, you have a massive perception problem, and there's no telling how long that takes to resolve itself, right? But if you want to make maximized returns, that's the way to do it. You buy things when the value is there and it reeks, right? Like nobody wants to touch it. It's incredible value. The outlook looks awful, right? Like and you hold it until the perception changes. And that's how you make your biggest wins.
Yeah. The whole thing with investing is like, you got to do it before the other people do it.
Yep.
If you do it when everyone else does it, you just get average returns. And that's kind of not the point. Like, you got to try to look ahead a little bit, imagine the world as it will be, position for it, wait for it to change. Obviously, plenty of times it doesn't work, but in the times when it does, like it can work more than a little bit. So,
and a classic example, before I put my foot in my mouth, let me check something real quick. But I think that I've got a perfect example of that. So if going into this year, and not if you and I were doing it, but going into this year, if you ask people, what would you rather own? Google and TSM, Taiwan Semiconductor, or NVIDIA? Everybody looked at you like you were stoned, right? They have both outperformed NVIDIA. Not by a lot, but they've outperformed NVIDIA, right? And think about the price you were buying them at, right? You weren't buying them at their most expensive level when everybody in the country was choking on how much of it they owned, right? So by definition, you were taking on a considerably lower risk investment.
To go back to that distance from the 200 week, again, not that it's some end all be all, but it was valuable. NVIDIA is still like 50% above it, even after this, this little bit of a downtrend it's been in. So I guarantee if any point in the year, if you compared those three to how kind of just overbought, oversold they were, like you say, that how much risk you're taking is just way different.
Yeah.
Now, obviously, if everything went perfect, maybe the reward was bigger for NVIDIA, but it's just if you're always optimizing for things going perfect, like that's just it's a bad way to do anything in life, especially investing.
Yeah. Well, and if you look at it, so yeah, now granted, why is that right? It's saying NVIDIA is up 2% after hours, 1.5%.
Oracle, I think, posted some good numbers and was cruising. So that very well may be the truth.
Oh, geez. Oracle's up 23%.
Okay, it was more than I saw earlier.
Holy smokes.
And they missed on earnings. So that was all looking ahead guidance stuff. Which means, hey, the AI story can kind of, get back together for a little bit. We are in such headline hockey with AI where like anything that makes it look a little suspect and it just starts falling apart. And then something like an Oracle, talking about where they see things going, and the next thing you know, you're right back in there.
And then it goes insane again.
And because no one knows what to think about it. So AI is going to be volatile.
The one thing I will just tell you is, I think the one thing you have to keep in mind, and look, when I say this, I'm not at all saying to stay out of AI. I don't think you can. I don't think it's prudent not to have exposure to AI, even at stretched prices. But find the stuff that isn't as stretched in there. Having said all that, the one caveat you got to keep is just know that you're paying a premium for anything in that space right now, right? And so my opinion is, when you're doing that, and if somebody were to ask me, Zach, and again, we've picked parts of it that are not absurdly expensive, so I feel comfortable the way we are. But if somebody said to me, Zach, why do you own those companies? They're more expensive than those. You're Mr. Fundamental, all that kind of stuff. And I go, because where they're valued at, I am totally comfortable letting these things get hammered and buy more at that point. The difference when you own some of these other flyers is when you're owning stuff that is trading at 20, 30, 40 times sales, it's really tough to determine when to buy, right? You're so stretched on price, right? If you drop 25% when you're that stretched, what leads you to believe that bottom's anywhere near?
Right.
Now if if I'm buying Google at 16, 17 times earnings, which we did, right? I'm sitting there going, what are you going to do if they go to 14 times earnings? I'm buying more, right? Just because I'm so compressed at that point, right? That's the tough thing about those high flyers. And that's why I just think that, a correction in that stuff at some point in the next 2 months and a nasty correction in some of that stuff would not surprise me at all.
Yeah. And we've had a mild correction in it, in the last, whatever, three weeks or whatever. Mm-hmm. Basically, you get a couple of bad headlines and it's like, oh, AI is in big trouble.
Yep.
And now, and then you get something like today and it's like, oh yeah, it's so back,
It's like it's a Wayne's World market. Game on, game off. It drives me nuts. And as much as nobody wants to do homework and do research, everybody wants to extrapolate. You know what I mean?
That is what the human mind loves to do for sure.
That is correct. All righty, buddy. Well, that does it for me. Do you got anything else to throw at the folks?
No, I'm good to go.
Hey,
PPI tomorrow.
Yes, PPI is a big one tomorrow. Other thing is we dropped our interview with Brad Sarsfield, senior director for the AI division there at Microsoft. Just some fascinating stuff that I didn't hear before, like that tidbit we talked about regarding how AI has improved the compute power of the Blackwell chips that NVIDIA is putting out, which was kind of amazing to me, right? Anyway,
that's the future, man.
Yeah. And Brad knows it better than anybody. He's living it on a day-to-day basis. So you guys won't want to miss that. And you can see that complete with video by just going to YouTube and searching for Know Your Risk Podcast. You can also use Google, knowyourriskpodcast.com, bulwarkcapitalmanagement.com. We're not hard to find. Anyway, have a great night, and we will see you guys tomorrow. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.